if you look at the underlying balance sheets of the various sectors, companies, households in the economy, like the period of 15 years of unbridled monetary stimulation has put them in pretty good shape to withstand these types of conditions, this tightening of monetary policy. And so that's taking even longer. It's less effective and taking longer than I think most people are expecting. So is there a pivot anytime soon? No way. Not close.
Okay.
And if anything, we need probably meaningfully more monetary tightening, before we get anywhere close to when the Fed is going to slow. It's going to reverse or start to ease or pivot or whatever the heck you want to call it these days.
How much more begs the question. We're at 4% now.
We can easily see a few hundred basis points more without. That wouldn't be that surprising. And if you look at what the Fed's looking at, which is the most important thing, look at what the Fed's looking at. Don't think, how would you want to run monetary policy? Doesn't matter. Jay Powell runs monetary policy. Don't look at what you think is likely to transpire 6 or 12 months in the future. He doesn't care. He's looking at the inflation numbers. And when you look at that, there is no relief. And if there is no relief, the Fed will not stop. That's the way it goes.
Do you think that they can get inflation lower without unemployment increasing?
No.
Okay.
And it's just, not to be too blunt about it, but it's not possible.
Mm-hmm.
And the reason why it's not possible is that the primary driver of the inflationary pressures that we're seeing today, it was supply shocks, it was oil, but the problem is that has then permeated into a very wide range of prices. More than 50% of prices right now are rising faster than 7% year over year, right? So rising 50% are rising faster than. And so what that reflects is that there's a permeation of the inflationary pressures, particularly starting to see in the services side of the economy, which is driven by wages. So you get a price rise, which creates a demand for higher wages, which then creates more money for spending, which creates a price rise, right? And that cycle has permeated from the goods. So goods is starting to deflate, or has, a lot of sectors have deflated, but goods is like 10%, 15, 20% of the US economy. That's not the thing that matters. The thing that matters is services. And now that we've gotten this dynamic in the services cycle, the only way to break the back of inflation in services is to have a weakening of labor market demand, of labor market conditions, which then feeds into weakening of wages.